Our first panel will share their tips on how they can lean into this kind of transformation while also maintaining a good balance of risks and returns. So I'd like to introduce our panel as they come up. We have our moderator, Ms. Christina Choi. Christina is Executive Director of Investment Products at the Securities and Futures Commission, and she's joined by Yie-Hsin, President and CEO of State Street Global Advisors, Laurent Ramsey, Managing Partner of Pictet, and Andrew Schlossberg, President and CEO of Invesco. So please welcome them all.
So good morning, and a very warm welcome to this first panel on investment outlook and long-term asset allocation strategies. So we have here distinguished leaders from 3 major asset and wealth managers from the US and Europe, managing multi-billions of assets under management among them, and they don't need any introduction. I'm sure you are all eagerly waiting to get some free investment advice from them. So I think just quick recap of what we heard yesterday from the summit. So we heard a lot about optimism about the U.S., the complexities in the macro backdrop, and structural changes as a result of geopolitical tensions, the changes in race, and also the recent U.S. presidential election. So for the U.S. market, we heard the 40s, tariffs, taxes, less regulation and tightening of inflation, and a growth agenda. However, it may not be good news for the rest of the world. And I think, since the U.S. election, many, economists have lowered the, forecast for other markets. However, on the other hand, the contrarians emphasizes more on these concerns about sustainability of the U.S. deficit, the debt level, the inflation risk, and I think we heard Julia mention the unpredictability of the new administration in the US. And also whether the election proposals are more for negotiation than will. So, but on the trade side, we heard optimism about China +1 and the opportunities in Asia and the global South, and the supply chains redistribution and the new regional alliances being formed. So in this part of the world, China has been bracing for the challenges internally and those from outside, with more loosening fiscal policies, particularly since September, followed by the recent announced 10 trillion renminbi support for local governments. And we've seen the surge of liquidity and outperformance of the Hong Kong and China equity market. So, we are in very interesting and exciting times. So, this first set of questions is about your views on the economic and investment outlook for the, next 12 to, maybe 18 months and longer term. In terms of the major economies, the US and the rest of the world, and of course China. So I will start with Yie-Hsin. You are the biggest, one among the biggest passive managers. How do you see, the outlook for the US and other markets?
Thank you. It's a real pleasure and honor to be here with all of you. So one of the key themes we heard yesterday morning was about resilience. And I would say 2024 has been exactly that, as we saw gains across equity and fixed income markets, growth continuing to be fairly resilient at the same time that inflation has been abating. And that has led to central bankers around the world beginning to execute on interest rate cuts, maybe with the one exception of Japan. And so as we look forward to 2025, we see that path, that sort of path toward a soft landing continuing. And from a global growth standpoint, we remain optimistic, primarily for 3 key reasons. One is, of course, that central bankers largely in developed economies have begun to ease. Secondly, you mentioned China's stimulus. We expect even more stimulus to occur, so that's likely to reduce the downside risk and ensure the 5% growth rate that we're anticipating. And then lastly, when you look to the US, the strength of the consumer is quite evident. And it looks to be that not only is their savings rate not at 3%, but closer to 5%, that along with the strength of the technology sector, where we see earnings growth continuing. And despite the run-up in the equity markets, we still believe that there is upside opportunity. So on balance, we are overweight equities with a greater overweight to the US market on balance. If we go around the world, we would say that Europe, because of the strength of the household and excess savings, we think there's some upside there. In Japan, we view that as probably more of a sideways market, just as we look at what is the continued and sustainability path of growth and inflation. And then here across the emerging markets, we think there are good opportunities. I mean, I know we'll talk a little bit more about what might be the policies coming out of the US, but to the extent that they are more inflationary, there's likelihood over the medium term that we're going to see weakness on the US dollar front. So that should suggest strength in the emerging markets. And broadly, across fixed income, it's going to be a volatile ride as we understand the data and the path of inflation. On balance, we are more focused around sovereign debt, and that's on a global basis, probably closer to the medium and short end in terms of maturity. And so we also think here there's opportunities for emerging markets debt. And then on the equity side, I think very much will depend on the path of travel with tariffs, trade wars. What does that mean country by country, company by company? And then, as I said, I mentioned China before. Feel reasonably confident that at least in the near term, you know, the government's commitment to maintaining growth will continue.
Okay, thanks. So turning to Andrew, so what's your views and take?
Yeah, well, first of all, thank you to the HKMA for having us back again. It's wonderful to be here. Perhaps it's because I live in the United States, I share a lot of the optimism that Yie-Hsin shared already, but perhaps it's worth maybe contextualizing back to sitting on this stage, or a stage similar, this time last year as to how different things are. So if we were sitting here last year, we were talking about 65 to 70% of the world's population, democratic population, going to go through some election this past year. We were talking about China stimulus, waiting for it to come, and even recognition that we needed it. And we were talking about central banks and what would their policy be. And here we are today in a much different position, and Yie-Hsin already shared a lot of those changes. And we see it as a great opportunity for risk assets in the equity markets, in particular, a broadening out into small caps and mid caps, into emerging markets and things non-US, and in fixed income, moving out a little bit on the curve and being in municipal debt in the United States or bank loans throughout the world. And we can get into all of the risks that certainly persist out there, but I think we've got great optimism.
Okay, can I have a follow-up? You know, you have some views about, you know, Hong Kong, and how do you see, you know, the role of, we heard about Hong Kong can be serving, you know, the trade, the changes in the trade alliances, and also ODIs of China. It's a lot, you know, coming out and serving. So in the financial services or the outlook of Hong Kong?
Yeah, so needless to say, many of us are here. And so the outlook for Hong Kong is quite high. We run our Asia Pacific headquarters here out of Hong Kong and have for many, many years and will for many years to come. We also operate our domestic Chinese business right in Shenzhen. And so the now called, you know, Greater Bay Area, as I've been coming here and our Shenzhen business and our China business and our Hong Kong business for over 20 years, it's prosperous. The resources are here, the talent is all here, the financial capital flow is very much alive and well. And I think the two-way bridge between you know, China and the rest of the world, but certainly this as an international center to connect all of us in the international investment community is really powerful. And as connected or unconnected as we may see ourselves in over the next several years, the capital markets will remain connected. And Hong Kong has always been a place where that happens.
Thanks for all the compliments of Hong Kong. But, you know, turning to Laurent, Europe. So, you know, we heard about the challenges, the war still going on, and, you know, in Ukraine and also Gaza. And the slower growth, but we have strong savings. So, and also, I think Europe is going elections, and we've seen the Draghi report. So can you share a bit more to us about the outlook of Europe and what does it mean?
Yes, of course. First, let me again thank the HKMA, the SFC, and the Hong Kong Academy for Finance for inviting me. I feel humbled to be part of this panel and surrounded by giants of the asset management industry. When it comes to Europe, and obviously sitting at the center of Europe, the continent, even though we're not part of the EU, we have problems to be too optimistic, at least over the short to medium term. We see growth below potential at 0.7%. We see growth next year, real GDP growth at 1.2%. We see, as you said, savings going up, consumption stalling. So I think it's going to be difficult for us to be positive on Europe unless we see a very strong recovery in this part of the world and China, on which Europe is pretty dependent. But also unless we see Europe tackling the issue, which has been highlighted by the Draghi report, linked to competitiveness of Europe. If you look at the top 20 stocks, publicly listed stocks in the world, you don't see one European name. So that tells you something about the competitivity of the continent going down. I think the report highlights a couple of issues in Europe. One is linked to innovation, and not so much whether there is innovation or not, but the ability of Europe to scale up innovation in Europe. A lot of the good ideas are actually, emigrating themselves towards the United States for different reasons. The second issue is linked to the energy transition that needs to be tackled and the impact it has on energy costs. The question of dependencies, you can think about defense, and obviously the question of access to a deep funding pool. Everything points towards a more integrated single market, whether you call it capital markets union or investment and savings union, like the new term, including banking union. And the question is whether this is gonna happen or not. And the Draghi report recommends three things: reviewing EU governance, simplifying regulation, which is overly complex in Europe, and again, trying to deepen the savings pool, which, in Europe today, 80% happens through banks and bank loans. Now, I was in Brussels 3 weeks ago, and everybody agrees on the conclusion of the report. Everybody agrees on the diagnostics, but when it comes into, turning intentions into action, member state interest still prevails. And unless there is a strong trigger to make them recognize that the greater good is perhaps more important than national interest, it's going to be difficult. So what can be that trigger? It can be perhaps a deepening of the war. It can be perhaps the US elections and Trump positioning on NATO and NATO funding or tariffs or some of those might be the trigger that we need for Europe to put its acts together. Now, there are glimpses of hope. So obviously, Southern Europe is faring better than Northern Europe, which is hard to believe, there's the revenge of the pigs, and not surprising coming from me, but Switzerland is a harbor of solidity and innovation. We think that from an asset allocation perspective, it's a high quality defensive hedge you can have. High value add sectors, you can think about materials, farmers, equipments, luxury, financial services. It has a strong currency, so from a US dollar investor perspective is interesting. And it is very innovative. It became again the best country according to the WIPO in terms of innovation. 3% of the population have PhDs, 3.3% of GDPs in R&D. Yep. So that's a glimpse of hope for Europe.
Okay. Good. There's still bright spots in Europe, right? Okay. So I think, I think, Andrew, last year you were here, welcome back. And you said that we have too much cash on the sidelines. And are we seeing investors moving to riskier assets or markets? And how much risk appetite is there with the expectation of, the higher for longer? We still have quite high rates and global slowdown of economic growth and high levels of public debt and all the risks in the world. So we also see some, questions from the floor. Cash is still king, right? Or, are there alternatives? Yeah.
Yeah, no, thank you. Look at money market assets and cash assets are still at record highs and making new highs. So there's still plenty of cash on the sidelines. I think it started to move this year, and Yie-Hsin talked a little bit about it, and Laurent talked about it as well. As the rate picture started to change, I think now as some stability starts to come back to markets, as people's willingness to take on more risk assets, we have seen money start to be in motion. Those cash balances, though, are still quite high. I mean, I think I said last year, from both developed wealth managers, they report out, low 20% cash balances in people's portfolios, and maybe that now is in the high teens. But it's now a strategic asset with where rates are, unless the rate picture materially changes, it'll still be a strategic asset. But I think there's plenty of opportunities that we, can talk about more of, and will talk more of. I think the one thing I'll add to the money in motion theme is that a lot of the stimulus, a lot of the policy changes, the retirement market changes that are going on in different places around the world that we can talk about, I think also create this change, generational change, or change in the way people are investing, or the catalyst and incentives to be in the capital markets is going to create more of a flywheel of money in motion where cash isn't going to be the preferred asset. It's going to be more in these risk assets. So still at record highs, sadly, to report, but I think there's a lot more visibility and opportunity to invest. And Laurent, I'll say, the valuations in Europe are quite cheap. So at some point, you only need a little catalyst for some growth.
Okay, so
Cheaper for longer.
Yeah.
Okay.
I said I'd play the optimist here.
Right. Good. Yeah, Yie-Hsin, so what's your take? You mentioned about, sovereign, maybe still good for the, the U.S. debt for short, medium term. So you concerned about, the sustainability of the U.S. Fiscal debt level?
Yeah, it's more of a concern, I think, for the medium term. The extent of debt in developed economies around the world is a theme. And you look at the U.S. alone, I think servicing the debt is going to be pretty close to 20% of the annual budget and will likely only grow. And so what that suggests is that there's just less dry powder to encourage greater growth. And then you marry that with what we see as aging demographics around the world. I was mentioning to these folks, when you think forward just to 2030, and the baby boom generation in the U.S., they will all be 65 or older. And so this demand for income, fixed income, dividend-yielding stocks, REITs, I think will continue to be a consistent theme. And we're just likely to be in a scenario where growth is just going to be lower. And so this argument of rates continuing to ease makes sense. To find the right neutral rate, our view, at least in the U.S., is that that's probably around 3.5, 3.75 by the end of 2025. And so as institutional investors start to think about where the opportunities are, we haven't necessarily seen all the productivity improvements, that we were hoping for. Obviously, technologies, whether it's renewable technologies, AI, quantum computing, all of these offer opportunities for some of that upside. And then thinking about secular trends, where those opportunities are. We are seeing lots of investments across infrastructure. We're talking about data centers quite a bit yesterday. All of that, I think, are areas, private credit's another one that has a lot of tailwinds. So really thinking about this spectrum of what kinds of investments can add alpha, and arguably private equity and venture historically has been in that camp. There's those that are diversifying in nature, and I would probably put infrastructure and real estate in that camp. And then lastly, those that can provide hedges. And so gold, for instance, is a really interesting asset class. We've seen that really run up pretty dramatically this year as sort of a hedge to geopolitical instability.
Yeah, so I think I have a question about gold. You know, what do you think is the appropriate proportion for gold? Anyone?
Got the large gold fund.
Well, we do. I don't.
You're running the biggest gold ETF in the world.
Yeah, I mean, I think what we've seen across portfolios is probably in the low single digits in terms of exposure, but it does provide sort of that geopolitical hedge. It's a safe haven. It has diversifying qualities, and so that's probably on balance where we see allocation.
So Laurent, your advice on the bright spots or the asset allocation?
Yeah, I think quite a lot has been said. It's true that following a brutal 2022, we've seen massive inflows in money markets and money market funds. We've fortunately been a beneficiary of that. But 2024 was filled with uncertainties on the geopolitical front. Whether inflation was going to be under control or not. So anyway, paid to wait. So basically, clients waited, were rewarded handsomely for that. Now, post US election, we start to see a reallocation of that cash. I think with short-term rates coming down, the opportunity cost of staying in cash becomes more expensive. We see a steepening of the curve. We see correlation between bonds and equities, being conducive to diversifying your portfolio. And we see an economic backdrop which is quite strong, with inflation under control and no risks of recession. So we've seen clients reallocating. We like, as we said, I'm not going to repeat what my colleagues just said, but we like the US. We like China, we like Southeast Asia, we like Switzerland. You got the point that we don't like so much Europe. We like banks, again, with a steeper yield curve and deregulation in the US. It might be a beneficiary. We like utilities, that might be the new tech, given the massive investments we need to do in terms of infrastructure. We start to like some emerging markets on the debt side, especially those that are a bit less vulnerable to US tariffs, and names that have suffered lately: Turkey, Argentina. We like India. Golds, like you said, we like having gold. I mean, it's not going to surprise you coming from a Swiss, but we like having some gold in portfolios as a diversifier. The thing we don't like is treasuries. You talked about U.S. debt sustainability. I think long term it might be an issue. I think Yie-Hsin, you said some of the figures that are quite staggering. 123% of GDP, and with expenses that are going to have to go up. When you think about social security, income security, healthcare, what is needed for the energy transition or defense. So we see that only going up in the US, and the cost of servicing that debt is massive. It's going to be bigger than the defense budget. So the key is going to be the ability of the US to continue to finance its debts. I think out of the 35 trillion of debt, 20 trillion is funded by the public, and half of that by foreign investors. So the ability to continue to attract foreign money is going to be key. And for that, two things need to continue. One, the US needs to continue to be a hub for innovation, which I think it is. And two, it needs to continue to be perceived as a safe asset. And here again, we're quite confident.
Can I ask you about demands for renminbi assets or bonds? In view of the growing trades, with the Southeast, Asia and global South, are you seeing? How do you see the demands, or from clients or investors?
So we're long-term optimists on the renminbi. Actually, in 2014, we were one of the first, at least in Europe, manager to launch a renminbi bond fund. So that's 10 years ago. So that tells you a bit about our confidence. But the fact of the matter is that it hasn't happened yet. Demand is low. After an initial uptick, we've seen allocation being reduced from our clients. I think renminbi is still 2% on forex reserves. So it hasn't picked up the way we would like to see it pick up, but we stay optimist over the long term.
Sure. Any?
I mean, I'll comment maybe less on the renminbi, but just China in general. Within our domestic China business, which is a retail business, both on the equity and on the fixed income side, we have seen a pickup in flows over the last 6 months as stimulus has come in. Certainly not back to where it was over the last several years. So we see some evidence of green shoots in China domestically. The domestic consumer or the domestic investor is starting to show that. I think the foreign investor is looking for more. And I think stimulus continuing to be big and bold, and as that starts to work through the domestic economy and maybe some of the instability of the political relationships, foreign investors I think will grow interested once again in China, but long term the trends and themes haven't abated.
Okay, so maybe anything you want to add?
I would just say when I think about fixed income investing, we have more and more investors now wanting to disaggregate the global ag. And so, in some cases, they are looking to invest more in China. Other cases, investors are looking to invest emerging markets ex-China, but it's also along every dimension. I think there is growing desire to be able to differentiate overweight, underweight, depending on the investor.
All right, so turning to the U.S. equity market, I think, you all seems to be optimistic, but how about the valuation, the high valuation and concentration in the few, big names? And, how can we diversify, or are there opportunities outside those 7 or few stocks? So who would like to start first?
I'm happy to start. I think if you look at the equity markets on a price-to-earnings growth ratio, it's about 1.5 times, which is below historic medians. And even with the tech sector, the Mag 7, it's 1.7. Our view is that actually the earnings growth of these companies is likely to continue. So I suppose we're more in the camp of there's still interesting names to own. Now, obviously, with some of the themes around President Trump, focus on tariffs, immigration, deregulation, likelihood of inflation, I mean, you're starting to see the market respond accordingly. Andrew talked about growing interest and demand for small caps and mid caps, and we see that diversifying. In terms of opportunities, the deregulation themes are going to benefit the consumer stocks, definitely benefit financials and banks. Defense is likely to be an area that's going to see increased demand. And then particularly in the US, I think the energy companies, even this focus around fossil fuels may pick up again. So those are some of the areas where we see opportunities. So much of this really depends come January. Exactly what are the policies and what is the implication and how much inflation do we see? The labor market, for instance, today is actually in decent balance. There's only about 500,000 jobs that separate openings and those that are looking for work. That's down significantly from the beginning of the pandemic, which was around 6 million. So even if there is some modest deportation, it probably doesn't add that much to the inflationary outlook. But I think this is a key thing. We expect the Fed to cut once again at the December meeting, but we have taken down what our expectations are for 2025. We were at 5. We're currently at 3. I think that's the key thing to really be focused on.
Okay, Thanks. So, Andrew?
Yeah, I mean, the only, Yie-Hsin, I think, summarized it exceptionally well. There's two U.S. markets. There's the largest 10 U.S. stocks, which are 40% of the S&P 500, and there's everything else. And, you know, those kind of numbers we haven't seen, you know, since the tech bubble into, you know, the early 2000s, 99, 2000s. So Yie-Hsin's comment's right, though. I mean, they're there for a reason. I think the changes that are going on in policy, and then I just think the valuation differentials create an amazing set of opportunities that I think some investors, you know, professional investors see. I think individual investors investing behind that need to broaden out. And Invesco is an active house, we're a passive house, we're privates, we're public, so there's not a bias that way. But I think active managers in particular, those that can go through the marketplace, public or private, and find these opportunities, they're going to be massive, and the valuation differentials are high. You just got to see some growth, and I think both can be true. You know, I think the top 10 technology stocks can do well, and a broadening of the market can do well under these conditions.
Laurent, other, you know, bright spots?
As I said, we like banks. I think that the deregulation is going to be, and again, a steeper yield curve is going to be a positive for banks. As far as technology is concerned, if we look beyond, you know, the big tech companies that obviously, you know, benefit a lot, because with the advent of AI, you know, you need to have lots of users, lots of data, lots of money to be able to you know, to develop those. There are some other sectors that might benefit. We like, as I said, some utilities linked to the need of electrification. You know, data centers are very power hungry. You need to produce that power. You need to invest in the grids and infrastructure. You need to cool that power. So I think that provides very interesting opportunities. I think three other sectors that are interesting, linked a bit to what's happening on the AI front. First is cybersecurity. I think that there's a new hack every 39 seconds. McKinsey estimates that in, you know, next year, cybercrime is going to cost $10 trillion per year. And cybersecurity solutions still have a relatively low penetration. So there is a massive market out there as companies are going to beef up their investments to be, to protect themselves. Cybercrime has the highest return on investment in terms of the time you need to spend and the risk you take in terms of being prosecuted and convicted. So a lot of people are taking that as a side job. So you need to protect yourself against that. The other sector that we like is robotics. I think Mike touched upon that yesterday. I think automation is going to be, is important in terms of also gaining productivity. This part of the world is the biggest producer of industrial robots, so it's there to benefit. I think China would need to increase its production, its usage of industrial robots by 2.5 times to reach the levels of automation of South Korea. So that gives you, an idea of the potential there is. So we like robotics, and the other part is some parts of health, diagnostics. For example, biotech might also benefit.
Thank you. So I think now turning to ESG investment, actually, this year we are seeing a bit of a drop in the ESG fund launches, and I think we noticed that ESG seems to be taking a more backstage in recent times, but we still know there's a huge demands for transition or investment, decarbonisation. So how do you see the I think investor demands for, and how to make investment for good investment for investors? So I'll start with Laurent, because Europe is notorious for its demands and keen interest in ESG investments.
Yeah, I think there has been some headwinds. You can think about policy or politics, a stalling COP process and commitments to the Paris agreements, stalling as well. You can think about regulation, and you can think about performance. When it comes to policy or politics, I think there are stronger momentum that are driving a long-term growth into sustainability. I think that it makes sense economically, and again, I think it was touched upon yesterday. Today, solar and wind is the cheapest source of energy in most parts of the world. It provides less volatility than other fossil fuel sources of energy. It provides independence. So when you try to build resilience, it makes a lot of sense. And if you look at countries, look at China in 2023. They increased their solar production capacity by 217 gigawatts, which is more than the total US solar production capacity. They invested $650 billion in energy transition in some shape or form, which is double the investment of Europe. So things are happening regardless of policy or politics. When it comes to regulation, and particularly in Europe, I think the debate has been hijacked by regulation and therefore compliance in our shops. When we launched our water fund in 24 years ago, we were talking about investment opportunity. Now people are talking about Article 8 or Article 9. It's very confusing for investors, and I think that is partly responsible why also there is, people are staying on the sideline because they don't understand. So I think we have a duty as an industry to be clearer in what we mean, and in going back to talking about the opportunity and not all that jargon that people are using. For us, ESG is about risk, is about doing your job as an active manager, because I think that ignoring non-financial factors, physical risk or transition risk is actually failing your fiduciary duty. So everybody should do it, and hopefully soon we won't talk about it anymore. And when we talk about sustainability, again, try to focus on the opportunity. On the demand side, there was a Mercer survey on asset owners this year that says that 79% of asset owners globally will increase their allocation to climate strategies. Morningstar shows that in the last 5 years, investment in climate funds has increased tenfold. And in our interactions with clients, at least 2/3 of our interactions are related to sustainability. So even though there is short-term headwinds, we see the long-term potential as being, untouched.
So Andrew, you have observed some integration or more embedding of, ESG investments, more on the practical level among investors.
Well, I think Laurent characterized it very well. And my only additional comment would be, if we could look forward, 10 years or so, that we're, well, the E and the S and the G are very different, and I think Laurent pointed those out. But I think we won't be talking about it in 10 to 15 years, not because it's not relevant, but because we're all in the business of allocating capital to companies for them to produce future cash flows and profits. And how things like energy transition, how things like consumer behavior, how products are created, it's going to feature. And so differentiating between the companies that can do that well and can't, I think, hopefully we're just not talking about acronyms in 10 or 15 years.
Good. So I think the last part of this, my questions, is about the rise of private assets, or the demographic changes and the need for longer-term assets. And we have a lot of insurance company and also pension funds managers here. And so in a way, yesterday we also heard about the PE industry is undergoing structural changes, and the VC returns are dropping and not, like they earning what they used to have, and you have to be very selective in investments, and the investment skills and opportunities are less. And also, while we have the golden era of private credit, we also heard the tide has not gone out, and we haven't seen the naked yet. So there seems to be still quite a lot of, we haven't seen the real risk. And of course, we are seeing, a lot of investment needs and in transition and all this and infrastructure, etc. And the rise of evergreen or less liquid funds, long-term funds for investors. And also, I heard a criticism of the regulators' misconception about the risk of private assets. So do you think private assets are for everyone, or what do you think? What is role in terms of who would be suitable, for the investment portfolio? So I started, Yie-Hsin, you have been in the insurance industry as well, and now as the passive managers, how do you see the rise of the private assets?
Well, a big theme for us at SSGA has really been focused around democratizing investing. I think yesterday we heard an example of, you go back 10 or 20 years and you wanted to invest in the market, you paid a big commission. And today, obviously, commission-free platforms are available. And when I think about the advent of the ETF industry, you can have $100 and get exposure to any number of, stocks. And so I think when you step back from, the conversation around, when will we see sort of differentiation across managers? I mean, this business has always been about skill, right? So I think that is fundamental. But at the same time, the number of public companies have declined dramatically. And, with the regulatory environment for banks globally have been pulling back in terms of extending credit. And so these are all areas where there is value creation happening. And so one could argue that institutions have had access to all of these asset classes for a long time, and we've seen allocations grow dramatically. Some of the largest institutions are potentially even north of 50% of their portfolio allocated. But when you look at individual portfolios, they're less than 10%. Now, I think it is important to take into consideration transparency, valuation, liquidity. All of these, I think, are important to take into account because individuals, through home ownership or through retirement savings, those can be more illiquid. And so to suggest that individuals should have the same allocation to alternatives as institutions, I'm not sure that's correct, but I do think there is room for more.
So Andrew?
Yeah, sure. Echo Yie-Hsin. Maybe I'd add, as retirement markets become increasingly self-directed, defined contribution plans, whether that's in the US, what's happening in Japan, even over time what will happen more and more in China, privates we need to help find a way for them to play a role, just like they do in a defined benefit scheme with institutions allocating significant amounts of their capital. I agree with the comments made yesterday too, that the blurring between public and private investment is going to take hold or can take hold. But the notion that I think one of the ways for the public markets to get re-stimulated is to make it more favorable for companies to enter the public market, whether that's regulation or whether that's just capital that's harder and scarcer to find from private sources maybe over time. And for banks are certainly going to play a role. This isn't all moving to private credit. Public credit and private credit are going to coexist. So in terms of democratizing it and bringing it to individual investors, I think Yie-Hsin covered it well. The only thing I'd add is that there is quite a steep learning curve, and education is going to have to sit really close to good investment capabilities. And I think we all have good investment capabilities. It's how do you create the education to prepare for illiquid moments, which will come.
Laurent, so you are, a well-known manager or advisor to the private world and private banks. How do you, are the private assets for everyone, or how do you advise the individuals to make the investment choices and monitor, the risks?
Yeah, first on the growth of private assets, we think that by 2030 it's going to be 20% of global assets, 45% of global revenues of the asset management industry. 80% of that will still be institutional money, mainly pension plans and sovereign wealth funds. But the private money invested is going to grow by 15% per annum, reaching 5 trillion. I think demographics is helping. I think, as Yie-Hsin said, there is a wall of wealth transmission which is starting and which will continue for the next 20 years with, I think, 90 trillion of baby boomers' wealth, which is going to go to the next generation. And as it goes into the next generations, obviously, the next generation has a longer longevity and therefore has the time horizon needed to invest more in private assets. And also something that people overlook often is that some part of that wealth transmission is actually done to philanthropic foundations. And those philanthropic foundations, by nature, have long duration when they deploy their capital. So that's another, I think, element that will increase the propensity of clients to invest in private assets. Now, when it comes to private individuals, we still see 90% of that savings pool coming from ultra-high net worth individuals and family offices. So when we talk about democratizing private assets, I think we still need to remember that this is what it's going to mainly address. And when we talk about retail investors, I think we need to be careful. I think that democratizing access through adequate wrappers for long-term investment is something. But the two risks I see is one, a risk of suitability, because to invest in private assets, you need to make sure you invest your nest egg, your reserve assets that you don't need, because even with semi-liquids, there are some risks. There is an illusion of liquidity that we have to be very careful about, and this is where transparency comes. Those semi-liquids, still give you a cap of 3 to 5% redemption on assets per quarter. So if a crisis hits, you're going to be gated. And this liquidity is provided, has to be provided somehow because you can't make something illiquid liquid. So it's either through, subscriptions, either through income distribution or through borrowing. So it has, or through putting liquids in a semi-liquid portfolio, which dilutes private asset returns. So I think, I don't think it's for everyone, but I think it's going to be a growing part of individuals' investments.
Okay, thank you. So I think, just last call for any questions for this panel. I think, I think we cover, most, but there is a question on crypto. Your views on crypto and the new administration, really, deregulation. Are you investing any crypto in your portfolio? Or what do you see? Are you planning to?
I think for us, our focus has been on sort of the broader digital environment, not necessarily the cryptocurrencies themselves. I mean, there are a number of different companies that are ways to play what we think will be a growing area, and it's very clear, I think, with the new administration, this is going to get tremendous focus, probably a top priority of our primary regulator, the SEC. But blockchain, I think we talked about yesterday, tokenization. There's a lot of opportunities in this space. And I would say as investors are really thinking about, we've talked about the short term, the medium term, longer term, it's really about these new technologies. And you asked originally about China. China is very advanced in terms of renewable technologies, advanced materials, quantum, digital AI. These are all areas that I think are quite interesting as we look out to the future.
Okay, thank you. Laurent?
Yeah, when it comes to the underlying technology, we're quite involved, and Switzerland is quite advanced actually in providing the infrastructure necessary. But to answer your question in terms of crypto and Bitcoin, do we advise clients to buy them? No, we don't. We let them do it. I think we try to give advice on things that we understand, and we can't understand everything. And so yeah, no, we don't provide advice.
Let them do it. Okay. Andrew.
I'll let them leave it at that.
Okay, I think we just have 1 minute, but I think, thanks very much. But the one last piece of advice or the most important investment, if you want to choose for the next, 2025, can you give us just one short answer from each of you? Andrew?
I just keep the long term in mind, try to avoid the noise, and think about the next decade, not the next 12 months.
Thank you. Laurent?
I think I would try to widen my exposure to the wider tech that can benefit from the very rapid developments on AI, as we discussed.
Thank you. Yie-Hsin?
I agree wholeheartedly with my panelists, and I would just say diversification broadly, thinking about what parts of your portfolio are addressing different environments that we might find ourselves in.
Yes, thank you. So please give a big hand to this panelists. Well, thank you.